Good evening and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang and I hope you guys can hear and see me. Right, today is of course January 25th, sorry, January 26th, and Trump is back in the White House for almost a week now, and he has done a lot of stuff, and he appeared to be very aggressive in signing executive orders left, right, and center. And of course, the market did react to the various executive orders. First among which was his mass deportation, which is currently caused a little bit of mayhem in the southern borders. And we also knew that Trump has signed among other stuff, he actually signed into law a working group for the crypto markets in terms of digital assets. He has also signed executive orders allowing drilling on federal land, and he has also urged OPEC to actually lower prices for crude oil. So there's a lot of stuff going on, and this week we'll be talking a little bit about what some of the key highlights of those things that he has actually done in the past week. Now, without much delay, let's get started. Of course, we will start off with the disclosure. Now, this presentation is not an offer to buy or sell any kind of securities, be it FX, CFDs, or any kind of margin financial products, and the trading of any kind of margin products to carry risk. And I will be sharing with you my views on the various markets, and do understand those are my views, and it's got nothing to do with the sponsor for the event, which is incidentally IronFX. And of course, the content of which has not been vetted by any regulatory body. Just be aware of this when you attend this presentation. Now, among the first few things that Donald Trump has done this past week is signing more than 100 executive orders, ranging from not determining there's only two gender in the United States, male and female, and no other any other variations. He has also signed key among all those executive orders, stuff that actually impacts financial markets. He wants lower interest rates, and he has actually told the markets that he wants the Federal Reserve to start lowering interest rates. Now, that will be a major problem because over the last few months, leading towards the end of 2024, we've seen inflation in the States has been showing signs of re-accelerating. So lower interest rate is not going to help in this sense. And of course, he also mentioned during his campaign trial that he wants to do away with the Federal Reserve. And now that will be controversy. And of course, this week, when we talk about markets, the day before his inauguration on Monday, on the 20th of January, he actually launched a couple of meme coins in his namesake. And that has caused a bit of a hoo-ha in the digital asset space, because that coin that he launched 24 hours before his inauguration has gone from mere cents to as high as $70, making Donald Trump something like $40 billion, assuming he did liquidate at a very high. Okay, so that is something that we also have to watch, because he is very, very pro crypto, which is a 180 degrees turnaround from his stand on crypto, especially Bitcoin, in 2020. So this is an about turn, and now he is all in favor of using Bitcoin as a possible strategic reserve to help resolve the U.S. national debt crisis. Now, again, this week when he signed into law the working group to find a way forward in terms of regulation for digital assets, he did not mention anything about the Bitcoin strategic reserve, which is a puzzle because he was talking a lot about it just weeks before his inauguration. So something may have changed in the meantime. And as of a few hours ago, I read a piece of news saying that Ripple may be part of that strategic reserve. Again, we have to watch how this particular asset space here is going to move going forward. Now, key among the data that's been released this week, we are talking about the weekly economic calendar. Here we start off at the beginning of the week on Tuesday. We have the claimant count change for the United Kingdom. Here we can see that the number of jobs has actually improved from the previous month of November, from negative 25,100 jobs to just about 700 jobs. So you can see the recovery is a little bit iffy at best. Okay, we can see that the UK economy is under a lot of heavy headwinds, and this is definitely not something that you can cheer about. Okay, we can see that the job markets in the UK is definitely very weak. Which went from a high of 102,300 jobs in the middle of 2024 to all the way down to negative 25,000 jobs. So we can see that is a big climb down in terms of the labor markets in the UK. And of course, further to the UK labor report, we can see employment change has climbed down from 173,000 new jobs to only 35,000 jobs. So again, this is a continuation of a pattern that we have seen since August of last year, from a high of 373,000 jobs all the way to the most recent numbers available for December of 2024 at 35,000 jobs. So this has been a climb down, in fact, a very steady climb down. And of course, correspondingly, we are seeing the unemployment rate has been surging higher. We can see that the market unemployment rate stabilized at 4% in August of last year, and it has been climbing to 4.4% at the end of December. So this is something that we have to watch, because the labor market in the United Kingdom is definitely getting from bad to worse, and this will impact. We're already seeing the negative impact in the gilt market, meaning to say the UK bond market has practically collapsed and the yield has been climbing. And at the current rate in which the bond prices or the gilt prices has been falling, it does suggest that UK is possibly entering into a very dire situation in which there has been a wholesale sell down in the bond market there, and this will have repercussion as far as the British pound is concerned, as well as the overall economic health of the UK is concerned. I think the UK is definitely facing a sovereign debt crisis, which may implode on the rest of the world. Okay, so keep this space. Watch this space, because I think it will have very bad negative implication for the rest of the global markets. Over in Canada, we can see inflation is beginning to perk up. This has been a trend which is very obvious in a lot of world, including the United States. So Canada CPI numbers, there are two sets of numbers here. On the left, you can see this is, there's one set of number by the Bank of Canada. We can see that inflation has actually bounced back up to 1.8%. The low was at 1.5% in the middle of last year. So we can see that that has actually been a bottom, and recent months we can see that the latest numbers suggest that there has been a perk up in inflationary pressure in Canada. And the other set of number, which is the headline CPI numbers, year over year, we can see that that is actually showing us a different set of scenario in which the index has been falling for 3 months in a row, having hit 2%. Currently it's at 1.8%. But so when you look into the two set of number, both are at 1%, but the number coming up from the Bank of Canada is showing a rising inflation, whereas the headline CPI numbers over the last 3 months has seen a climb down in the headline inflation numbers. But by and large, you can see that if you believe the Bank of Canada's number, it does suggest that inflation is definitely looking to come back in some form in the coming months. Okay, so this is something that we have to watch. And of course, in going into this week itself, there will be expectation that the Bank of Canada will be looking to cut interest rates, and we will talk about it later on in the economic calendar for the coming week. In New Zealand, we also see that inflation has not been climbing, but it has not improved. Nonetheless, we can see the inflation has actually stabilized a little bit. The way they calculate their CPI numbers in New Zealand is very different. Very much like Australia, they calculate their CPI numbers based on a quarterly basis. So this number is definitely lagging, because if you do not measure those numbers on a month-over-month basis, instead measure them on a quarter-over-quarter basis, those numbers become very laggy. And the last number that we have on Q4 of last year, these headline numbers quarter on quarter is currently at 0.5%, does not show any significant rise. And on a year-over-year basis, it appears to have stabilized at 2.2%. So this is something to cheer, because it has stopped falling. So we want to watch how this numbers is going to be performing in the months ahead. The Bank of Japan did something that we all have been expecting. They actually hike interest rates again to 0.5%. Now, this is the highest interest rates the Bank of Japan has actually seen since the global financial crisis in 2008. So this is 180% turnaround in the monetary policies of the Bank of Japan. So we can see that that has also been done on the back of rising inflation. As far as the Tokyo CPI number is concerned, we can see that that will be the reason why the Bank of Japan has been more willing to actually reverse the decades of negative interest rates. So right now, Japan interest rate is 0.5%. Now, the last time the Bank of Japan actually hiked rates, it caused a major seizure in financial markets in terms of the yen carry trade. This time around, I think they have learned their lessons and they have actually put up a forward guidance to actually calm market participant expectation of any kind of disturbances in the very massive trillions of dollars yen carry trade. So it did not have any major impact. In fact, the dollar yen has actually strengthened, meaning the yen has actually weakened on the back of a hike in interest rates by the Bank of Japan, which is something very unusual. Okay, later on, when we go to the chart to look at the dollar versus the yen, we can see that it has bounced back up instead of going down, as well as the Nikkei 225, which is the Japanese equity markets, instead of falling, has actually now climbed over 40,000 very convincingly this time. Okay, so this is currently what we are seeing here. The market is expecting more interest rate hikes by the Bank of Japan in the months ahead. Now, when we look at the Purchasing Managers Index measuring the health of the both the manufacturing and non-manufacturing sectors in Germany, we can see that the number here suggests that the services is doing pretty well, 52.5%, which is way above the level of expansion, whereas the manufacturing is still in a doldrum, although it has improved from the number in September. Now, in September, the manufacturing PMI was in the depression level of 40.6. Currently, it's at 44.1, still a depression number, but it has been improving over the last 4 to 5 months. So hopefully this is something that can continue in the years, in the months ahead, because after all, Germany is a major manufacturing powerhouse, and recovery in the manufacturing is very crucial to the health of Germany and by extension to the entire Eurozone itself. So here we are watching that at least the services sectors in Germany is doing A-okay, because at the lowest point it was in contraction zone at 49.3, and this was only as recent as November. So the latest number for the month of January is up 52.5, which is a good sign. So hopefully the services sector can actually keep the economy going while the manufacturing is trying to recover from its depth of 40.6 all the way back in September of last year. Eurozone PMI has also improved. Similarly, we can see the sector that is holding up the entire Euro area is actually the services sector, is maintaining at 51.6, 51.4. I have to update this, and the manufacturing is very much in depression zone at 45.3. So manufacturing is still a major problem for in regards to the entire Eurozone. But services seems to be the bright spark in the economy. So this is very much a mirror image of what we are seeing in the Germany economy. Okay. UK, we are only looking at the services sector because UK is a major services sector economy, and we do not need to see the manufacturing sector because it's not a major component of the economy. Services sector is barely surviving. It is only scraping above the 50 marks at 51.2, still a very weak number, but nonetheless, it has climbed up from the low of November at 50.8. But again, you can see overall, it is not a fantastic number, although it is barely just treading water above the 50 mark here. Okay, so again, going forward, I think in the next few months, I think there will be a lot of headwinds for the UK economy, and for the best performing sector in the services sector, it is already struggling. So it is not good going forward for the UK. Okay, so definitely we are seeing that this week, based on this number, we can see that the FTSE 100 has actually climbed out from this all-time high. And like I explained last week, the reason why the European equity index is at record high is purely from the currency perspective. From the American perspective, when you look at the the European equity markets, they do appear to be relatively cheap. Okay, because the currency has actually fallen quite a fair bit relative to the dollar. So from that perspective, European equity does look cheap to the Americans, and that has been the reason why they are at record high going into this week. But since then, the market has climbed back down based on the PMI numbers that was released over the last few days. And this was the number coming out from Friday. Okay. US Purchasing Managers Index, we can see that this is the S&P Global version of the index. Remember, in the States, there are two sets of PMI numbers. One is from the ISM, the other one is the S&P Global. So this is the S&P Global version of the same index. Manufacturing is managed to stay above 50 for the first time. Now, this is something that we want to cheer because the US manufacturing sector has not been able to go above 50 since July of last year. So this is the first time this month that the PMI numbers in manufacturing has actually managed to stay above 50. So I think the market is taking it in good stride. Services sector has pulled back from the high of 56.8 going into the end of 2024. Now we can say there has been a major markdown in this sector here. It's a major climb down from 56.8 to 52.8. So services sector seems to be taking a hit, okay, whereas manufacturing seems to have recovered quite nicely. Okay, so both these two set of numbers cancel each other out. Okay, at the end of the day, there'll be a new administration in town, and we will have to see how market reacts to the new administration based on the many things that Donald Trump has been doing this past week. He has been very busy. Okay. Now, going into the coming week itself, these are the numbers that we'll be watching at coming in on Monday. Tomorrow, we will be receiving the PMI numbers from China, both in the manufacturing and non-manufacturing numbers for the month of January. There is no expectation. I think the number will stay relatively quite similar to what we saw in December last year. As far as manufacturing PMI is concerned, it's likely to stay at 50.1, barely above the expansion zone. And whereas the non-manufacturing, referring to the services sector, although there is no expectation, it is likely to be about the same at 52.2 for the month of December. On Wednesday at midweek, we're going to be seeing the CPI numbers for Australia. This will be released on a quarter-on-quarter basis for Q4, expected to bump up from 0.2 to 0.3%. The monthly CPI numbers for the month of December year over year expected to surge to 2.5 from 2.3% relatively. Okay. Then, of course, we will have the interest rate decision by the Bank of Canada. I expect to cut interest rate by 25 basis points from 3.25% to 3%. Then on Thursday, we also have the FOMC, which is the Fed interest rate decision. Market have no expectation. It is highly unlikely the Federal Reserve will do anything. I think they will hold at the current level at 4.5%, despite Donald Trump wanting the Fed to actually cut interest rates. Okay, be careful what Donald Trump wants, because a cut in interest rate will result in a weakening of the dollar, which will lead to a consequential a drop in the dollar, which will have very severe consequences going forward. Okay, so as far as interest rate is concerned, I don't think the Federal Reserve should listen to Donald Trump, because they are supposed to be independent, and what Donald Trump wants may not be something that he can get based on the numbers that we've been seeing in the inflation numbers, which has been creeping higher over the last few months. And Germany will be releasing the Q4 GDP numbers. Quarter on quarter, we expect to see a dip from 0.1 to negative 0.1. Year over year on Q4, expect to go back to 0 from negative 0.3 from the previous quarter. Okay, Eurozone will also be seeing the GDP numbers again quarter on quarter, expect to dip from 0.4% to 0.1% for Q4, and year over year expected to bump up from 0.9 to 1%. So again, not really fantastic numbers here. And of course, we will also be expecting some kind of interest rate movements as far as the European Central Bank is concerned. The main refinancing operation rate is expected to be cut from 3.15 to 2.9%, and the rates on deposit facilities is also expected to dip from 3% to 2.75%. Then Friday, of course, we will have the all-important labor number coming up from both Canada and the United States. And on Friday morning itself, we will be seeing from Tokyo, the Tokyo Consumer Price Index year over year. No expectation, but the previous number for the month of December was at 3%. The core consumer price index, meaning to say if you deduct, if you take away the food and energy component for the month of January, expect no expectation here, but the previous one was at 2.4%. Retail sales for Germany, no expectation. Previously was 2.5, and the consumer price index month over month expected to dip from 0.5 to 0%, whereas the year over year number for CPI has no expectation. Previously was 2.6%. Now this will be the big one coming on the evening on Friday. This will be the major number to watch out for this week, which is the personal consumption expenditure for the United States. The core PCE number month over month expected to double from 0.1 to 0.2%, whereas the year over year number has no expectation, but it's also likely to see some kind of increase from 2.8% for the month of November. Then on Saturday itself, we will be, of course, market will be closed, but they will be releasing the Caixin manufacturing PMI. No expectation here, but anything below 50 will be bad news. Okay, so there you have it. This will be the calendar for the coming week itself. It's going to be a very, very busy week. Okay, and market will move. So now let's go into the price chart itself. Now, if you have any question, do drop them into the chat box so I can address them as they appear. I will start off like usual with the Dow Jones itself. I want to show you the weekly time frame. So the Dow Jones has recovered very, very nicely. We all know that the S&P 500 has once again registered a new all-time high, but this is not being seen in the other major equity index. The S&P 500 has actually bounced back up after a very strong performance the week before. So now we can see that there is a good possibility the pullback that we see may actually be over. That's because the Dow Jones has actually been climbing. Okay, the S&P has been climbing to fresh all-time high. The Dow has not, but it's looking like it will actually see a follow through as well. So we will have to watch what happens, because in my mind, the technical pullback that we see from the all-time high at 45,078 does not look to be over yet, but the last 2 weeks has been a very strong reaction in the marketplace. So it could actually cancel out the initial pullback that we see from all the way in November of last year. Okay, so the market has gone into a 1 month some kind of correction, and now we are into the 1.5 months reaction, and the market may have actually bottomed out here at 41,733. So again, we have to watch. I'm not convinced that the correction is over, but based on the performance of the S&P 500, maybe that is putting a spanner into the into my analysis here. But here we have to watch out. Okay, now I've always maintained that this bull market is by no means over. So the fact that it is reacting strongly over the last 2 weeks is not at all surprising. Although I like to believe that we may see we may get to see another pullback all the way into March of this year itself. Here we will look at the other time frame, principally the daily time frame. So you can see the daily time frame and see a pullback, okay, from a high of 45,078, and the bottom here is 41,733. So there's a good chance that going into this week itself, we may see the continuation of this pullback here. So that would be the ideal evolution of what we are seeing in the Dow itself, a pullback below 41,733 towards 400. Okay, that would be ideal. Okay, but again, we have to watch for reaction. If the price actually close above 45,000, let's say 100, that means to say that this analysis for another pullback is not valid. Okay, anyway, we will see what's the reaction over the next few months, the next few weeks. Here on the S&P 500, I'm going to show you why I say the market has gone to a fresh all-time high. So this is the S&P 500. You can see the market has gone to fresh all-time high. Okay, this is a new high, marginal high. So this actually eliminate the corrective pattern that we see here from the high here that we saw in December. Okay, so This is a very shallow retracement. Market has gone back into new high, and of course, it has cancelled out the previous corrective pattern. But here it does looks like the market has done what I would see here as a three wave. Okay, from the bottom here, the 2,189. This is a three wave pattern which have actually hit equality at 6,115. The high so far this past week is what 6,127.3. So this is a three-wave corrective pattern. Unless the market accelerates to the upside, there's a possibility we may see a pullback. But again, now that the market has closed above the previous high, it is highly unlikely. Now we look into the daily itself. The daily actually confirms what we already saw. The market has resumed its up run. It barely missed its projected target at 6,129.55 with a high of 6,127.30. So again, this is what we are seeing. Possibility of an extension to the upside, quite possibly. So right now, the S&P 500 appears to be exhibiting strength and is leading the major equity index here. We look at the Nasdaq next. You can see the Nasdaq over here. We can see that the weekly time frame is again testing the all-time high. So far, the all-time high is at 22,132.1, and this market here has a high this week at 21,944.6. So it does look like it's maybe going to attempt a fresh all-time high in the coming days. Okay. Based on the daily time frame, you can see this has been the price action. We have a three-wave pullback, but this could all end up to a more complex three-wave. This we have already have one set of three-wave. For all we know, it could end up as another second set of three-wave targeting 1,908. 1,985. Okay, so again, there's a possibility of another continuation of this pullback. Again, we have to watch how the market evolves in the coming days here. So we are finished with the US equity markets. Let's go across the pond to look at, let's say, the FTSE 100. The FTSE 100 has gone to a new high. The high traded is at 8,586.9. Now, this is very interesting because at the end of trading for the week itself, it ended as a pin bar. So this is potentially negative, signaling there's a possibility of a top in place. So again, based on the economic data that we have been seeing, it is definitely not a good development. And now, technically speaking, there is a reversal pattern in the weekly time frame. So this could be consequential. So watch out for lower prices and possibility of a reversal happening here is actually very good. On the daily time frame, we have also a very bearish development here. This is what we call a bearish engulfing bar, and this is definitely very, very bearish looking. So in combination with what we are seeing in the weekly time frame, the outlook for a top in place is very, very high indeed. So going forward into this coming week itself, any kind of bounce to the upside is an invitation to sell, okay, in my opinion, with a stop just above the most recent high that we saw at 8,586.9. Okay, so this could be a good counter trend development here in the FTSE 100. Now, when we look at the DAX, which is the German index here, we can see the German index is also having an all-time high. The new all-time high is 21,519.8. You can see this is on the back of very weak economic numbers, and definitely we want to see confirmation of a top in place very similar to what we are seeing in the FTSE 100. So this is no reason to go in to sell just yet. Okay, we have to wait for the market to tell us that the market is likely has exhausted itself. Right now, there is no sign that it has done that yet, just yet. Yes, the market closed on a weak note on Friday, but this is not a reversal pattern, at least not yet. Okay, so we want to see more confirmation as far as the price action is concerned. Okay, but it's something to look out. Now, over in Asia, we want to look at the Nikkei 225. Now, we all knew what happened this past week. Nikkei has actually been reacting to a hike in interest rate by the Bank of Japan. You can see that market has closed back above 40,000 very, very convincingly. In fact, this is the highest close we have seen since the market hit a top at 42,519, all the way back in June of last year. So this is a this is a development we have to watch. But because prices right now does not look very impulsive just yet, it still looks a little bit of a struggle to go higher. But on a close-to-close basis, it does look like the Japanese equity market has not reacted negatively to the high in interest rate. Usually, a high in interest rate will cause equity prices to fall off, but we did not see that. Okay, instead, it has actually managed to hold on to its gain even after the rate hike by the Bank of Japan. On the daily time frame, we can see Friday has a strong reaction to the upside. But overall, we can see that this, it looks like, to me, a flag, okay? And it may not have momentum to the upside. So again, do not try to buy this index just yet. Wait for the market to tell us what to do next. In the meantime, we are not able to sell as well. Again, so in the meantime, we are in that situation in which we will want to watch for further development, ideally with some kind of reversal pattern to the upside, okay? Right, and over in Hong Kong, this is the Nikkei 225. You can see that the Nikkei has actually closed on a stronger note this week, but it is still very tentative. Now, China is about to may have market is expecting the Chinese government to actually roll out a stimulus package now that we know what Trump is going to do. Now, the worst case did not happen. Now, going into Trump's inauguration, there were a lot of talks that Trump is going to impose a very punitive 60% tariff on top of this existing tariff that has been imposed. And that did not materialize. Trump only announced a 10% tariff on top of the previous already known tariff. So it was on balance not the worst case scenario. So the market have a bit of a bounce. But what will cause this market to actually power higher is some kind of stimulus package by the Chinese government. So we are still waiting for details of that. But the market is in the expectation mode right now. So you can see that on a technical basis, the level between 21,300 is very, very crucial because the previous time the market attempt to rally, it has been kept at this level at 21,300. So right now, if the market do actually advance higher, it must close above this level to have any momentum to the upside. So this will be technically a barrier to cross. And if the market can convincingly close above this level at 21,300, it will have the momentum to go even higher. But until then, this will be the level to watch for any kind of cap to the upside. Okay. Like I said, if you have any question, do drop them into the chat box so I can address them. So now that we have seen this, we want to also look at the currency markets. First of all, we want to look at the euro versus the dollar. Now, the dollar actually weakened this week, and that allows the market to actually go higher. Okay, so we can see the other currency has actually have a strong showing this past week. The euro has actually have a major bounce, and this has been consequential for me because you can see that I barely survived being stopped out, okay, and the market has recovered very strongly this past week. Hopefully it can go a bit higher. I want to exit my trade here, hopefully with my shirt intact, okay. So this has been a premature long position for me, and now it looks like the market is giving the dollar has been coming off, okay, because Donald Trump has been talking about lower interest rates and because he wants a lower dollar so that he can compete in the international markets to bring down to narrow his trade deficit with his other trading partners. But like I mentioned, a lower dollar may not be in the best interest of the United States right now. Okay, so if the US if Donald Trump actually forced the hands of the Federal Reserve to cut interest rates to achieve a lower dollar, I think that will be a disaster as far as the global economy is concerned. Okay, because if the dollar loses value, all other assets priced in dollar will also go down the tube. Okay, and that will not be good. So what we want to see right now is that the dollar remains strong, which I think technically it will remain strong because we've been seeing the yield has been climbing. And this is also a reflection of the very weak bond market right now. Bond market is practically having a free fall, which is resulting in a sharp rise in the yield. Okay, so instead of looking for a crash in the equity markets, I think a crash is currently happening in the bond market. This one was something that we will have to watch because as far as the European are concerned, when the bond market actually collapse, it would actually bring about the prospect of a very severe sovereign debt crisis. Okay, and if there is going to be a war, or rather an escalation of war, in particularly in Europe, okay, then it will be very consequential. Incidentally, I think in the second quarter of this year, the risk of an escalation in the war in Europe is actually very, very high. We have already seen the UK actually has been positioning their troops. I think the last I read was about the UK has sent 20,000 troops to be stationed in Romania, and France has been basically talking about taking over from the US as far as the leadership is concerned, and they are all aching for a escalation of the war. So if a war actually unfolds involving NATO in direct competition with Russia, that could actually cause all the analysis to go out of whack. Okay, I think that prospect is actually very, very high going forward. So this year, going into the second quarter of 2025, look out for an escalation in the war in Europe, which will cause a lot of gyration in financial markets. Yeah. And when you look at the daily time frame for this currency here, we can see that so far it's highly unlikely that we can see a quote above 106 as far as the euro versus the dollar is concerned. Okay, but the market has actually crossed beyond the 104.40. Okay, which is a good sign because this has been the level that has been capping the euro versus the dollar. And this week itself, we have a very strong, convincing close above this level, which actually should be very good going forward for the counter trend rebound. Okay, right now is we are being seeing a technical rebound. Right, and over in sterling, we are seeing the same pattern playing out in the sterling itself. We see a sharp rebound from the low of 1.21. Okay, and the previous week we see the low traded to 1.21, and this is a continuation of this rebound that we see. You can see the rebound coming out from 103.60, and this is an extension of that rebound. At the most, this can do is if the market can close above 134.40, would be the challenge, the high here at 142.5. This will be seen as part of a technical rebound. Overall, the market here is actually pretty weak for all currencies, and it is no surprise going forward. Over time, I think we will see the dollar strength returning. Okay, so this week itself, we've seen a very, very strong recovery, especially on Friday. The market closed all the way to 124.80. Okay, this should extend into this bracket of prices, but it should be kept below 128.10. Now, the major one to watch will be, let's say, for example, the Aussie. The Aussie have somewhat not such a strong recovery compared to Euro and the Sterling. You can see the recovery in the Aussie is actually not as strong. The low traded is 61 cents, okay, to the dollar. So this is part of a downtrend movements targeting anywhere between 58 cents to 60 cents. Okay, so this bracket here may eventually be seen, and this will be this three wave here. Okay. And in the daily time frame, let me see what the daily is. The recovery is pretty weak. You can see that this is a three-wave recovery. For all we know, at the beginning of this coming week itself, we may see this market unravel again. Okay, so the recovery in the Aussie is not very, very encouraging. Now, what about dollar versus Canadian? You can see that the dollar come off against the Canadian dollars. Okay, this is a bearish engulfing bar. Technically speaking, this could have negative implication, at least in the immediate future. The high traded this past week is 145.15, with the possibility that it may continue to trade lower. But again, this should only be seen as a technical pullback in a very bullish dollar market here. Overall, the dollar is still very evidently very, very strong. Now, this is the daily time frame. You can see that this is a key pin bar. The market traded to a high at 145.16 and end up like this. Okay, this particular bar here is particularly damaging as far as technical is concerned. So at the most we can expect is a 50% bounce from the very top here. Okay, so it has already achieved 50%. So going forward, I think topside will be quite limited. In fact, if you want to play this market, at least in the near term, to look for any kind of bounce, into this bracket of prices between 144.70 to 145.15, and then if the market struggle here and give us another selling signal, go with that for a simple three-way pullback targeting 141 half. Okay, so this is the best we can expect. Overall in dollar Swiss, I know some of you are watching dollar Swiss. As far as the dollar versus the Swissy is concerned, we can see there's not much of a movement. Okay, we can see that the overall trend is still down. We can see that this is part of a bounce from the lower 83 cents. So 83 cents at most, we can see the market challenging this 92 cents level. Okay, so the week before, we can see this market actually have a doji, which is a sign of struggle here. Okay, so this week the market come off is no surprise, but again, this is seen to be a part of a technical move, not a trend itself. And over the daily time frame, you can see daily time frame, the market has been struggling below the 92.5 cents. So this anywhere between this darkened pink area is area of opportunity for trading counter trend. Okay, now we can see that at the peak over here there is a pin bar, okay, at 92 cents high. So it has resulted in 2 weeks of pullback. So this may actually continue to see further pullback all the way maybe to 90 cents. All right, now we are done with currencies. Let's move on. Oh yeah, maybe I want to mention dollar versus a Sing. Okay, now of course, the news this week is that the Monetary Authority of Singapore actually adopt a more relaxed outlook for the Sing dollars. So this has actually not caused the Sing dollars to be very, very strong. You can see that over here, we can see the dollar actually moved down very aggressively against the Sing dollars, which is actually counter trend to what the MAS is trying to achieve. The MAS is trying to loosen the trading band for the Sing dollars. We can see that instead of going higher, the Sing dollars actually strengthened against the dollar. But of course, it's nothing to do with the Sing dollars. I think the movement here is overall the dollar is coming a bit of under pressure this past week itself, and it's very evident across all currencies relative to the dollar. So we see a major pullback in the dollar value versus the Sing, meaning to say the Sing dollars has been strong. Okay, I think what the MS is trying to do is to weaken the Sing dollars going forward. So I will not be surprised if the Sing dollars, the dollar Sing actually bounce back up over the next few weeks. But for now, I think the momentum is against the dollar right now in favor of the Sing dollars. So this is just something that I want to highlight. Okay, next we talk about commodities. Let's take a look at gold. Okay. Gold has actually attempted to take out the previous known all-time high. The high traded this past week is at 2,785 and 94 cents. Okay, so this is not far away from the all-time high of 2,790.09 cents. So there's a good prospect here on a close-to-close basis. We can see this is the highest close ever, where the market closed at $2,689.26. This is the highest closing we have seen spot gold ever traded to. So there's every prospect we can see a breakout of these levels into fresh all-time high. Like I say, this pullback is only seen to be a technical pullback. Now the market has finished that part of the move, and the market can close above 2,790.09 cents on a close-to-close basis. It signals that a resumption of the bull market here. And this is also coincide with the weakness in the dollar this past week. Gold strength ties in very neatly with the decline in the dollar value. Okay. So this is the weekly. Let me show you the daily. As far as the daily is concerned, we can see that there has been an attempt to go higher. So there's a very, very high possibility that this coming week itself, we will see a new high in the gold market. Okay, prepare for that. And in the silver, let's take a look at how the silver has been performing relatively. On the week to week, you can see that the silver market has been underperforming. There is no follow-through buying, and there is no sign that there's going to be a big surge coming in the silver market. So as far as silver is concerned, it is still underperforming relative to gold. And I do suspect that somewhere between the low here at $26 to $27.42 could be where the market will finally rest if it is trying to look for a bottom. Okay, so by and large, the focus has been on gold rather than on silver. So there's nothing to see on the silver market. I will pass the silver market altogether and look at oil. Now, oil is getting to be very, very interesting. Now, this is the first week of the return of Donald Trump 2.0. And Donald Trump's policy as far as energy is concerned, he wants to open up more production within the United States. And he has been busy allowing drilling on federal land. And this 48 hours ago, he actually urged or rather pressured OPEC to actually lower prices. So whether or not he will be able to get what he wants remains to be seen. But based on where the prices has been doing, if you look at this overall in the weekly time frame, it appears to be a double bottom is already in place at $65 thereabout. $64 has been the bottom. So this most recent low here is $64.75. And it does look like the bottom is in place and the market may be trading higher. Although this week ended on a weak note, but I think the market low is possibly in place. So this is a possibility for us to get back on the long side of the oil market here, okay? And although Donald Trump wants to increase production, which theoretically should actually lower prices, result in lower prices for crude oil, but I do see, technically speaking, the possibility of a double bottom and prices may actually escalate to the top side, especially if my view about an escalation of war in Ukraine actually comes into play, then that will cause a major run-up in oil prices. Okay, so Trump may not get what he wants eventually. So if you look at the daily time frame, I'm actually rather bullish as far as this week's pullback is concerned. Okay, going into this week's, which is the Trump's inauguration, the market actually has been buying up crude oil all the way up to $79.35. And this whole week has been a one-way street, and it actually traded to a low this week at $73.82 for the WTI. Lower, this is a lower to buy market as far as concerned here. There's a very natural support here at this level at $72.31. So if the market continues to trend lower, followed by a reversal pattern, then I think we should get back in on the long side of crude oil. Okay, so this is something that I'll be watching this coming week itself to re-engage to go back long on the crude oil itself. Okay. And when we look at the other markets, in particularly the Bitcoin. Bitcoin has traded to a new all-time high, $109,567.13 per token. This has been an all-time high. So not very strong closing, but currently trading at 104,721. Okay, so it is a new high nonetheless. But this could be a fake move for all we know, because the market only managed a marginal high against the previous all-time high here at 108,334 per token. This is considered to be a marginal high, and depending on how it closes, but I think it should close somewhere around current levels, but it is not very convincing for me. Okay. And then when you look at the daily time frame, is there any sign the market has already top up? This is what we are seeing in the daily time frame. A new high is traded, but it closed weak. So the market right now is trying to recover. It's again not very, very strong indication that we will see another run up in prices. For all we know, this could actually unravel. Actually, I have the view that Bitcoin will go into a substantial decline all the way into March of this year. Okay, so I am not very bullish on Bitcoin right now at the current levels. I think there is the prospect of a pullback. Okay, so if the prices do ever go in trade about 107,400 all the way to the all-time high of 109,600 thereabout, I think this area will be crucial. If it end up as a reversal pattern, it could signal possibility the continuation of this corrective pattern. Okay, maybe way below what we have seen so far. Right, this is my daily view on the Bitcoin sell down. Let's take a look at the other major coin, which is Ethereum. Now, Ethereum has been underperforming relative to Bitcoin. There's no new high traded in Ethereum. The best it can do is $4,106. The all-time high is quite some time ago at $4,860.25. So we can see as far as Ethereum is concerned, it is definitely underperforming. There is no incentive for the price to go higher. So the focus is not here. Okay, I think the focus is somewhere else. Like I mentioned, 24 hours before Trump's inauguration on the 19th, Trump and Melania actually launched meme coin for the Trump coin, and it has actually surged from nowhere to above $70 per token. making Donald Trump more than $40 billion, assuming he cash out at the very top. Last I checked was $23 on the height of $70, almost $80 per coin. Okay, so the focus has been on other coins. Now the Trump coin is actually based on the Solana blockchain. So Solana actually also benefited from the run up in the Trump coin itself. And of course, focus is still focused on the Ripple. So like I said, Ethereum is not where the focus is. So we don't have to be looking too much into Ethereum. Instead, we want to look at Ripple. Okay. Now Ripple is interesting because Ripple has stopped achieving new high. Last week, we have a high of $3.40. Now, this coin here actually started to run up in the months leading to Trump winning the election in November. So this has been a major surge in prices from below 50 cents all the way to $3.40. So this has been seen a big move here. And it's every evident to suggest that we may see even higher prices going forward. Okay. Again, just hours ago, I read an article in which Donald Trump says that Ripple will be part of that strategic reserve. Now, Trump has been talking about building a Bitcoin strategic reserve to solve the national debt. And the most latest executive order did not mention Bitcoin at all in this particular reserve, but he did mention a digital assets reserve. So that leaves the possibility of other coins being included into this reserve other than purely Bitcoin. And Ripple is going to be a major part of it because hours ago I read that Trump says that Ripple will be part of this strategic reserve. Okay, so again, watch out for more higher prospect of higher prices in this particular coin here. Okay. So in the daily time frame, the market has been struggling. You can see that the market has gone into that bit of a consolidation, but by and large, you can see that this is a very strong move. Okay, market has not fallen. It has not risen, but it has not fallen. So I think the market is in holding pattern right now with the prospects that anytime there is any kind of catalyst, it will once again bring buyers back into the market. And if the market can close above $3.40, the run will continue all over again. Now, earlier on, I did mention the Trump coin is based on this blockchain called Solana. So Solana has actually also benefited from the big move in the Trump coin. Okay, Solana has been in the up and up for quite some time now. The highest traded was $295, and of course now the market is struggling a little bit because the fever surge in the Trump coin has actually petered out from nearly $80 per coin. Now it's trading at $23 odd. Okay, so that has also bring down the fever pitch in the Solana prices. Okay, this is something that you want to watch. If you don't have exposure in the Trump coin, you can do it through proxy using the Solana token. Okay. Okay, I think I'm at the end of my presentation. Do you have anything that you want to ask me as far as the markets that you want me to cover? If there's nothing you want me to cover, I want to wish all of you a great Chinese New Year, which is happening in the next few days. All right, guys. Next Sunday, I think I will take a break for the Chinese New Year. I'll come back to you the week after. Okay, that means next Sunday there is likely to be no webinar. I will confirm that by you just have to watch out on my Facebook posting. So if there's going to be one, I will definitely let you know. All right, guys, thank you very much and wishing all of you a great year ahead. Bye-bye. Take care.